Welcome to The Explainer. Today, we are going to peel back the layers on a name you've almost certainly seen at checkout, Affirm. Let's dig into how this multi-billion-dollar business actually works.
Yeah, you've definitely seen this button. It pops up everywhere when you're shopping online, right? Whether it's for electronics or clothes. But have you ever really stopped to wonder what's going on behind the scenes? What's the engine running this thing?
Okay, so let's get right to it. What really happens when you click that button instead of, grabbing your usual credit card? It's a lot more than just splitting up payments. From your perspective, you, the shopper, the whole thing is designed to be super smooth, right? You just shop like normal, pick Affirm, and boom, you get an instant decision. You see exactly what you'll pay and when. No digging for a plastic card, no filling out some long, tedious application.
And this right here, this gets to the very heart of why Affirm even exists. It was started way back in 2012 with one big idea: to be a clear, transparent alternative to the old-school credit card world. You know, the one with all the confusing terms and interest that just keeps piling up. Affirm's entire brand is built on that simple promise of clarity.
And this is the one promise that really hits home for people. It's what truly sets Affirm apart. Think about it. Almost every credit card out there hits you with a fee if you're late. Affirm built its entire business model on the idea of having absolutely no late fees. It's not just a feature, it's literally part of their DNA.
Okay, but here's the thing. This isn't just about giving you, the shopper, a new way to pay. Nope. It's also an incredibly powerful tool for the stores you're buying from. It's a classic two-sided deal where, ideally, everybody wins. So you've got this really neat balance. On one side, shoppers get what they want: clear, fixed terms, that instant yes to buy something, and, most importantly, no fear of late fees. But what about the stores? Well, they're willing to pay Affirm a fee because it's been shown to get more people to click buy and to put more stuff in their carts. And this is crucial, Affirm takes on all the risk of lending the money.
All right, this is probably the question you've been waiting for. If they're so proud of having no late fees, then how on earth did Affirm make over $3 billion in revenue last year? Where's the money coming from?
Yeah, the numbers are just huge. We're talking $3.2 billion in total net revenue for their 2025 fiscal year. So let's actually follow the money trail and see how they do it.
Okay, so where is that $3.2 billion actually coming from? If you look at how it breaks down, it's really from a few key places. The biggest slices of that pie? Well, that's the fees that merchants pay Affirm for every sale, and also the interest that some of us consumers pay on our loans.
So let's break that down. Who really pays? The answer is, it's kind of shared. First, the stores, the merchants. They pay a fee to Affirm to help them make the sale. That's how you see those amazing 0% interest offers, by the way. Second, for a lot of the standard loans, we, the consumers, pay a simple, fixed interest rate. And then there's a third piece. Big investors and funding partners actually buy these loans from Affirm. That's what gives Affirm the cash to keep the whole engine running.
Now, holding this entire business together is an incredibly powerful tech engine. We're talking about something that makes millions of split-second decisions at a scale that's, well, it's just massive. Okay, this is Affirm's secret sauce. They don't just look at a simple static credit score like the old days. No, they have this really sophisticated machine learning model that's crunching huge amounts of data to decide in real time whether to approve you and how much risk is involved. And it does this for every single transaction. The whole thing happens in just a few seconds.
And if you want to understand the scale we're talking about, just look at this number: $36.7 billion. That's how much stuff people bought using Affirm in just 1 year. It's called gross merchandise volume, and it's just a staggering amount of commerce.
So who's behind all that spending? Well, it's a rapidly growing army of 23 million active consumers. 23 million people who are actively choosing Affirm when they get to the checkout. But hang on, because this next number might be the most important one of all for Affirm's future. 94%. An incredible 94% of all their transactions last year came from people who had used Affirm before. That tells you their product is incredibly sticky. Once you use it, you're very, very likely to use it again.
Okay, so let's zoom out and look at the big picture for a second. Because for all of this amazing growth, the data also shows us something really important, a key dependency that you absolutely have to understand to get the full story on Affirm. So, get this. Even though Affirm is available at almost 377,000 different stores, its business is actually super concentrated. Just one partner, Amazon, makes up 22% of its entire business.
And if you zoom out to their top 5 partners, that's almost half of everything they do. Now, that concentration is a massive strength, for sure, but it's also a pretty big risk. Those key partnerships are everything.
So, there you have it. Affirm completely shook up the world of consumer credit by building this huge business on a simple promise: transparency and zero late fees. But the big question now is, what's next? In a buy now, pay later market that's getting more crowded every day, how does Affirm keep its edge and stay ahead of the pack?